see what each other is doing. We trend by performance, so only the top people get to be seen by the thousands of people on the site. So this week, right now, as I speak, the market is attempting to rebound, but it raises the question, why did the market correct this week? So why would this be happening? Well, last week I said in the previous video that right now the Buffett indicator, which is the total market cap over GDP, is historically high right now. What this means is the sum value of the stock market is exceedingly higher than the amount of output that the US does. That is a worrying sign, because as you go higher and higher away from the GDP, it means that the price of the stock market is going farther away from the reality of the actual output that the economy is doing. So historically, as of today, the stock market would likely return negative 2.8% a year. But this is based on the past, and this is the future now. Anything in the future can happen. All this data, check it out. It's on gurufocus.com. So the other side of the coin, though, is that right now inflation is extraordinarily low. The reason why it's important to look at inflation is because it's going to indicate what the Federal Reserve is going to do with interest rates. And basically, at the end of the day, interest rates are going to tell you if money is still pouring into the economy. The moment the inflation rate starts to drive up, you're going to start to see money leave the economy, which means that there's less money for the stock market to go up. But right now, interest rates are significantly low. They're back down to levels way back from the 2009 recession. So this makes sense. The coronavirus is currently happening. We're trying to get our economy going again. But with cheap money, that means that people are going to throw this excess amount of money into the stock market. This might sound crazy right now because a lot of people don't have money, but right now the real economy is disjointed from the basic economics of the stock market. So this money is going out there. Big businesses, big banks have it. They're going to invest it somewhere. It's going to be the stock market. So that's why we've been seeing a rise up so far. So there's this friction between the fact that the Federal Reserve is still pumping money out into the economy, and that's some of it's going to go into the stock market no matter what. But at the same time, the stock market is very objectively getting overvalued. The amount of stuff we're making, the amount of money we're making as a whole economy is much lower than the valuation of the stocks themselves. So what do we do? What do we do about this? Panicking is always a perfectly reasonable option. You can panic sell everything and just give up on the stock market until calmer waters arrive. But it probably isn't the best thing to do at this point. I've been saying that the market's been overvalued for 3 years. You can check out all our videos where we interview people. And I think every single video, everyone agrees that the stock market is overvalued. But we just keep on being wrong because it keeps on going up. So it gets even more, it's either getting more overvalued, or maybe we're not fully understanding the psychology of the stock market right now. So panic selling, feel free to do that. The other thing you can do is maintain the course. Keep your portfolio as is. For some people that may be wanting to take a bite out of options, this could be a good time. Getting a few puts, nothing crazy. Just know that if you buy a put and the market goes up, your put's going to be worthless. That being said, having a small put could really ease the pain of another significant drop off of the market. A covered call essentially is when you already have the stock and then you sell to someone else the call so that if the stock goes up, then they have the right to buy the stock from you. The reason why you might want to do that is you get a little fee for selling that call, and if the market goes down, uh, that sold call will actually be worth more to you because you will be able to keep the fee and so forth, and maybe even buy it back at very quickly. So using options to protect yourself is a reasonable course of action as well in this uncertain time. Last thing you can do is you could take a diversification to your portfolio. Right now, utilities have been hammered, and I was going to show a whole bunch of utilities that had great dividends right now, but it's pointless. Just look them all up. They pretty much are uniformly showing relatively good dividends. For those of you who don't know, dividends are earnings that a company makes that they give to their shareholders. So taking in some dividend stocks in general could be great right now because what's still falling, regardless of this recent rise, are non-tech stocks. They are being better adjusted to be a real price per individual stock. The whole stock market is going up because of tech stocks for the most part, which is a mix of true earnings and also a mix of rampant speculation. So diversifying a little bit, but still holding on to maybe some of your tech stocks or other things, that's I think a perfectly reasonable strategy also right now, especially if you can get in on these really nice dividends into utilities and other companies that are doing well, but are being valued a little less because money is flowing into other assets that are more speculative. So those are my thoughts for the investment meta this week. Thank you for listening, and we'll be out again next week. Thank you.